TelevisaUnivision's Q2 revenue drop, U.S. ad softness and debt refinancing explained. Big news in the world of Hispanic media. TelevisaUnivision, the massive Spanish-language media giant, is sounding the alarm over a potential revenue slump in the second quarter. The company attributes this downturn to what it calls softness in its U.S. advertising business, a term that's sparking debates among industry insiders. But here's where it gets controversial. Is this just a temporary dip or a sign of deeper challenges in the evolving ad market? Let's break it down. TelevisaUnivision recently issued a formal warning that its Q2 earnings will likely fall short of expectations. In a press release, the company hinted at financial struggles, citing weaker than anticipated ad sales in the U.S. This isn't just a minor hiccup. The firm is actively negotiating with banks to restructure a $580 to $585 million loan due in 2027 and extend its credit facilities. To put this into perspective, the company's debt-to-EBITDA, a key financial metric, ratio now sits at a hefty 5.5 to 5.6 times. For context, even the most established media companies rarely exceed 5x. So this number raises red flags. And this is the part most people miss. The ad slump comes amid broader cost-cutting measures. Just last month, Donna Speciale, the executive leading TelevisaUnivision's advertising and marketing division, stepped down. Her departure has left many wondering whether this is a strategic move to streamline operations or a reflection of internal turmoil. Could her exit signal a lack of confidence in the company's ability to adapt to shifting advertiser priorities? We'd love to hear your take in the comments below. Meanwhile, the company's streaming arm ViX is hitting a high note with over 10 million global subscribers. That's a bright spot, but it's not enough to offset the ad revenue woes. In related developments, competitors like DirecTV are rolling out new Spanish-language streaming bundles, and niche services are even being sold for as little as 99 cents during Prime Day. Could these trends pressure TelevisaUnivision further to innovate or cut costs? Or will its sports programming, long a cash cow, stave off the downturn? The jury's still out. To stay updated on how this unfolds, keep an eye on the full report from Deadline Film Plus TV. And if you're curious about the broader implications for the Hispanic media landscape, let's dive into the comments section. What do you think is the biggest threat to TelevisaUnivision's future? Ad market volatility, internal leadership changes, or stiff competition from streaming rivals? TelevisaUnivision Q2 earnings, U.S. ad revenue dip and ViX subscriber boom. In a surprising turn of events, Spanish-language media giant TelevisaUnivision reported a 2% drop in U.S. advertising revenue for the second quarter of 2025. Despite this, the company managed to achieve a 2% overall revenue gain to $816 million, thanks to a 9% increase in subscription and licensing revenue. This news comes after the firm had previously warned of U.S. advertising softness and foreign exchange impacts affecting their latest quarterly results. The decline in U.S. advertising revenue was somewhat offset by improvements in other areas. The company noted a sequential improvement compared to the first quarter, driven by the strong performance of their sports content and the stabilization of linear ratings. This highlights the importance of diversified content offerings in maintaining revenue streams. But here's where it gets interesting. TelevisaUnivision's streaming service, ViX, has surpassed 10 million global subscribers, showing double-digit growth year over year. CEO Daniel Allegra proudly announced that ViX achieved profitability after just 2 years in the market. This success underscores the growing trend of streaming services capturing younger audiences, with ViX now offering both free and premium tiers, including a new ad-supported premium option. However, the company's total revenue for the second quarter dropped by 4% to $1.21 billion. This was largely due to an 11% decrease in Mexican advertising revenue, resulting in a total company ad decline of 5%. Subscription and licensing revenue remained steady, with U.S. gains offset by a 23% decrease in Mexico. The growth in ViX's premium tiers in both regions helped to counteract declines in linear platform revenues, particularly related to the renewal cycle with a key distribution partner in Mexico. On July 14, TelevisaUnivision had warned that overall revenues for the second quarter would fall year-on-year due to U.S. advertising softness and foreign exchange impacts. Moving into the third quarter, Allegra noted modest softness, but assured analysts that advertising sales were in line with expectations, bolstered by new series launches. This marks a shift from the economic uncertainty experienced earlier in the year. Allegra also highlighted the company's strong TV sports offerings, including Univision's coverage of the CONCACAF Gold Cup tournament, where Mexico triumphed over Team USA in the final. Additionally, TelevisaUnivision's audiences relied on the company for timely news on the expanding anti-immigration crackdown in the U.S., including workplace raids and their impact on communities south of the border. Operating expenses dropped by 9% to $812 million, impacting the bottom line. Despite this, TelevisaUnivision posted a quarterly adjusted operating income before depreciation and amortization, OIBDA, of $398 million, up 10%. This was driven by focused execution and continued growth in direct-to-consumer DTC services. In a move to streamline costs, Allegra announced that the company would no longer produce content for ViX that wouldn't also air on linear TV in the U.S. or Mexico. The new strategy is to only greenlight content that can be shown on at least two platforms, ideally across all three: linear Mexico, linear U.S., and ViX. What do you think about TelevisaUnivision's strategy to focus on multi-platform content? Do you believe this approach will help them navigate the challenges in the advertising market? Share your thoughts in the comments below. ViX streaming service hits 10 million subscribers. What it means for the future. In a stunning achievement, ViX, the streaming service under TelevisaUnivision, has smashed through the 10 million subscriber mark worldwide. This impressive growth represents a leap from 7 million subscribers at the end of 2023 and showcases double-digit year-over-year expansion in the company's Q2 of 2025. Several factors contributed to ViX's robust performance during the quarter. Notably, the platform capitalized on major sporting events such as the CONCACAF Gold Cup and the FIFA Club World Cup. Additionally, ViX formed a strategic distribution partnership with Disney, integrating its U.S. networks into Hulu Plus Live TV. For Mexican subscribers, ViX bundled its service with Disney Plus, enhancing its appeal. Innovations in content delivery also played a role. ViX recently launched 6 micro-dramas, short-form episodes tailored for vertical video consumption. The platform aims to roll out 40 such micro-dramas by year-end. Despite ViX's soaring subscriber numbers, TelevisaUnivision's overall revenue dipped by 4% to $1.2 billion. The Mexico segment experienced a more significant revenue decline of 14% to $394 million, partially offset by a 2% revenue increase in the U.S. segment to $816 million. The company had previously warned investors about this revenue drop, citing adverse foreign exchange rates and a softening U.S. advertising market. Total advertising revenue fell by 5% to $742 million, with the Mexico segment seeing an 11% drop to $287 million. In contrast, U.S. advertising revenue decreased by a more modest 2% to $455 million, showing improvement from Q1 as ViX's growth and linear ratings stabilized, buoyed by strong sports content performance. Subscription and licensing revenue remained flat at $443 million, but grew by 2% when excluding foreign exchange impacts. This growth was driven by ViX's premium tiers, which counterbalanced declines in linear offerings, primarily due to a renewal cycle with a key Mexican distribution partner. The U.S. market saw a 9% revenue increase to $348 million, while Mexico's revenue declined by 23% to $95 million. Since taking the helm as CEO in September last year, Daniel Allegra has implemented aggressive cost-cutting measures. These efforts, combined with growth in the direct-to-consumer division, led to a 10% increase in adjusted operating profit to $398 million. Operating expenses decreased by 9% to $812 million in Q2, driven by cost-saving initiatives such as reduced content, technology, and marketing costs, as well as the normalization of DTC-related investments. In December, TelevisaUnivision announced layoffs as part of a broader restructuring plan, affecting a mid-high single-digit percentage of its workforce. Around the same time, Jesus Lara, head of local operations in the U.S., left his position. Additionally, U.S. ad sales president Donna Speciale stepped down in June, less than a month after the company's upfront presentation, and was succeeded by Tim Natividad. TelevisaUnivision closed the quarter with $585 million in cash on its balance sheet. Cash flows from operating activities for the three-month period ending June 30th reached $272 million, a significant increase from the $88 million reported in the prior year's quarter. Capital expenditures remained steady at $23 million, matching the previous year's figure. In July, the company successfully refinanced $1.5 billion in existing debt by issuing new senior secured notes due in 2032. TelevisaUnivision is also in active discussions with its commercial bank lenders to refinance its term loan and revolving credit facility, both of which are set to mature in 2027.